I'm Casey Tollefson. I'm the Executive Vice President of Finance and Administration here at the Foundation. One of the most important ways we support our mission is by carefully stewarding the resources entrusted to us. Our investment strategy is built for the long term. You will hear us say a lot that we are not timing the markets, and it's a very important thing that we always like to emphasize because with a long-term strategy, we focus on stability, sustainability, and growth that helps us meet the needs of Montana today and for generations to come. To do that, we work closely with our investment committee and our amazing partners at Cambridge and Associates to make informed, disciplined decisions. Today, we're joined by two of our trusted advisors, Tim Shepard and Alyssa. And with that, they will talk about how our portfolio performed in the first quarter of 2025 and what they're keeping an eye on as we move forward. And so with that, I will turn it over to Tim.
Great. Thank you, Casey, and lovely to see all of you. Thanks for joining and spending some time with us. For those that have joined one of these investment updates, we will recover some things that we've talked about. You'll hear us say that we have an investment philosophy. It doesn't change as markets change and as events and news changes. We like to take the long view and the long-term approach. But we'll cover some background about the investment team, about Cambridge Associates, as well as our investment philosophy. I will then spend a few moments on markets. Of course, for those of you who read current events and stay up on the news, there's plenty to talk about. So if there are questions, please. Well, if there's questions for anything, please don't be shy. But of course, plenty to talk about markets, and then we'll talk about the investment portfolio, performance, exposures, things like that. We'll leave plenty of time for questions. As said, you can come off mute towards the end and just jump in with questions. If not, you can put them in the chat. We'll make sure we get to them as time permits. As Casey mentioned, you're joined also by a important colleague of mine, Alyssa Shing. She'll have some airtime, so you'll hear from her. And then we're joined by one of our crack investment analysts, Shirley, who help drive some slides. We do have some content to share as well. So we'll pull up some slides, so we'll have some visual things to go through. And why don't we go ahead and do that? So Shirley, if you could pull up the slides at the beginning, a little bit about background of our firm and our team. Of course, we nondescript name, Cambridge Associates. We could, I guess, be doing anything with a name like that. But we're in an independent investment firm. Could we just go ahead to the next slide, please? I think it's page one. So we're
Sorry, can you guys see the slides?
Yes.
Yeah, I think Tim is frozen.
I think Tim is frozen.
Well, while we wait for Tim, I can jump in and just provide an overview about Cambridge. We have been around for 50 plus years with a global team that spans across different continents. We're headquartered in Boston, which is where Tim, Shirley, and I currently sit, but we have offices in Europe, Asia, and soon to be in the Middle East. It looks like Tim is back.
Hey everyone, don't know what happened, but it's a remote meeting, so these things happen. I got kicked out of Zoom, so sorry if that was disruptive at all for folks. Where did you lose me, Alyssa? Where was I? Before,
I think I just only said a few words about our global reach and our headquarters in Boston.
Okay, so I'll if I recover a couple things. Sorry about that. We've been around since the 1970s. We're an independent firm. We hit our 50-year anniversary a couple years ago. We have about 1,300 employees globally. I think I heard Alyssa say we do have offices all over. We are headquartered in Boston, which is where almost our entire team is. We have one colleague who is in our DC office, but Boston is our headquarters, has been since we began. It's our largest office. However, London, San Francisco, DC are our next largest offices. Singapore is also a decent sized office for us, but we have an office in Sydney, Australia, Munich, Germany. And again, I think I heard Alyssa saying we're about to open an office in the Middle East, or if we haven't already, we're about to. But we're an independent firm. We have, again, one line of business, and that's to work with clients like the Montana Community Foundation to manage their investment portfolio in a customized way. It's actually how we started, so it's really very much a part of our DNA. We started working with mainly university and college endowments back in the 70s, and then brought in other types of nonprofits. But it's a bulk of the business, and it's something we're proud to really have as part of our DNA. So a little bit about the actual investment team that works with the community foundation. If we go to the next page, this is us. So this is the investment team. As you can see, I'm listed as the director of portfolio strategy. Just a little bit about myself. I joined Cambridge in 2013, so been at the firm for a while. Omar Sanchez, who is the chief investment officer, and then Jill Shaw, who works with us on private investments, and then Heather Russell, who works with diversifying strategies or hedge fund investments. They've all been at the firm for over 15 years. I haven't quite hit 15 years yet, so working on it, but it's a very long tenured, tight, cohesive team, which I think is something that isn't always super common in the investment and finance industry. People do jump around a bit, but we have a pretty long tenured team. We've all been working together for a long time. Personally, I work with a really small number of US based not-for-profits like the foundation. Sorry, everybody. I obviously having technical difficulty, so I'm gonna pass it on to Alyssa, because I think I've said plenty, and she was gonna come up next, and I might join from my phone to stop being so disruptive. So again, sorry for the tech issues, everyone, but it does happen. Apologies.
So if we're gonna move ahead to the investment philosophy, I can start here. So our core investment principle begins with a long-term investment horizon, recognizing that the Montana Community Foundation is designed to exist in perpetuity. So with that, we construct customized portfolios that seek to maximize returns while taking investment risks that are appropriate for the foundation's mission and objectives. To do that, we build growth-oriented portfolios, allocating to public equities and private investments, as we believe that these are the primary engine for long-term growth. Another key part of our investment philosophy is diversification. We like to build portfolios that are diversified across asset classes, geographies, and investment strategies to build a portfolio that is resilient and one that can generate those stable returns needed to support the foundation. When we think about managers, we are committed to identifying and partnering with the best active managers, those with the skill to deliver strong risk-adjusted returns net of all fees and expenses. And then as we think about tactical deviations, we generally try to limit those from our long-term asset allocation targets, as we believe that maintaining discipline and adhering to a well-defined long-term investment strategy is critical to achieving the foundation's goals. And then the final point on this page is our investment philosophy is also grounded in risk management and active oversight of portfolio risk factors, with a continual focus on delivering strong risk-adjusted returns that support the foundation's mission for the decades to come. So on the next slide, we have what we call the building blocks of portfolio construction and their role. As you can see, and as I mentioned, we believe in building portfolios with meaningful allocation to growth investments, which are in those blue and green shaded parts of the bar. These are the investments that we would expect to be the primary drivers of performance on an absolute basis. You'll see we make a meaningful allocation to public equities, which we also invest in across different geographies. So within equities, we like to diversify across global, US, developed ex-US, and emerging markets. We also like to make meaningful allocations to private investments, which is that green chunk of the bar. And you can think of strategies like private equity and venture capital, as we believe that these are assets that can drive long-term returns in excess of public equity markets. Moving down the bar in that purple shaded region, you will see that we allocate to diversifying strategies, which we expect to provide additional diversification and also a unique source of value added uncorrelated to broader equity markets. So strategies that fall into here, you might think of hedge funds, such as a long-short equity manager or a multi-strategy manager. Moving down in that orange slice, we have an allocation to inflation-sensitive assets, such as TIPS, which offers protection against inflationary pressure and is also meant to serve as a source of spending reserve. And then finally, at the very bottom in that yellow, we have an allocation to what we call deflation hedging, which includes our more defensively positioned fixed income assets, such as US Treasuries and cash, which are there to help provide additional protection and also that liquid source for any kind of spending or rebalancing. On the next slide, we have a slide that we like to land on to help illustrate why diversification is at the core of our investment philosophy. So what you see here is commonly referred to as a quilt slide, which displays the annual performance ranking of major asset classes over the past 20 plus years. Each asset class is represented by a different color square, and the rankings for each year are arranged from the best performers at the top to worst at the bottom. So as you look across the slide, you'll notice that the colors shift positions from year to year, creating what you might call a patchwork effect. And what this shows is that there really is no single asset class that consistently outperforms, nor is there really a predictable pattern to that asset class performance. For example, if we look at the far right in 2023 and 2024, you'll see at the very top, we have US equity in that dark blue square. But if we look just one column to the left to 2022, you'll see that dark blue square for US equity towards the bottom. And this just also shows the frequent rotation in performance leadership, just further emphasizing the unpredictability of short-term returns and also the risks of trying to time the market or chase the previous year's winners. So all of that to say, this, I think, is a helpful exhibit to illustrate why we build diversified portfolios. By spreading investments across a range of asset classes, we reduce the impact of any single asset class's poor performance and help smooth out the highs and lows. And I would say diversification not only reduces volatility, but also provides a more stable and reliable path to achieving long-term investment goals. So rather than relying on that one asset class, a diversified approach positions us to capture the opportunities across the market while managing risk through all the different market cycles that we go through. The next slide that we included talks a little bit about market timing and shows why this is not part of our investment philosophy. I think while the idea of moving in and out of markets to capture gains and avoid losses may seem appealing, the reality is the practical challenges and risks far outweigh any of the potential benefits. So looking at the top half of the page, we show the annualized return of equities over the past 45 years and the impact to your return if you missed a handful of the market's best days. So starting on the far left in the blue, this shows that if you had simply stayed invested, equities delivered an annualized return of 11.6% over this period. However, if you missed only just the 10 best days out of the 11,827 weekdays in this period, your return would drop to 9.5. And then as we move further to the right, you'll see missing the best 20 days reduces your return further to 8.2, and the best 30 days cuts it to just 7.1. So this just also shows the majority of our long-term equity returns are driven by a small number of very strong days, and those days are nearly impossible to predict in advance. So that's why we emphasize that time in the market is far more important than timing the market. And we can also see this if we look at the bottom half of the page, which looks at an even longer time horizon. So here, this scenario is if you invested $1 in equities in 1900 and simply stayed invested in that first blue bar on the left, you'll see that dollar would have grown to over $116,000 today, thanks to solely the power of compounding. However, if you just missed one good year, such as 1933, you would have a value that is 35% smaller, about $40,000 less than if you had just stayed fully invested. So this is why we believe in a disciplined long-term investment strategy that focuses on staying invested. Market timing is extremely difficult, and clearly the cost of missing a few days can be very meaningful. That's all I have to say for this section. I can pass it off to Tim, who will talk more about markets.
All right, everyone. Hopefully you can hear me, and maybe third time's the charm with tech troubles on my end. I joined audio from my phone, which is a good workaround for those who haven't had to troubleshoot on Zoom. You can have Zoom call you and join on the phone. So again, hopefully this works. When we go to the next page, and I'll say a few things about markets, what we're seeing, what's going on, but to orient all of you on page 9, here are market returns for a variety of different asset classes. Left-hand side is the month to date, so this is April data. Right-hand side is year to date. Blue is different stock markets with global, so that the global stock market, developed markets, United States, etc. The yellow circles are fixed income or bond indices, and then we have real assets such as real estate, natural resources, and gold, and then the dollar. So I don't know if any of you are living under a rock, but 2025 has certainly been a pretty interesting market, to say the least. Every time you open the newspaper or read the news, there's something going on, and that's the case every year, but this year feels particularly eventful. So despite that, we've certainly seen volatility in markets, really globally tick up quite a bit. Despite that, we've actually basically round tripped where we started the year. So through April, I'll orient you to the top right-hand side. You'll see the global stock market was down 0.4% through April. And despite all the volatility that happened in the month of April, the global stock market finished up that month just about 1%. And in fact, if you were to fast forward this data through Friday's close, so roughly halfway through May 16th, you'd see that markets basically across the board are in the black. They're positive on the year. And through Friday's close, global markets were up 6% for the year to date. And in the U.S., which has actually been underperforming non-U.S. stocks, despite being the best place to invest over the last couple of years, the S&P 500 index is actually now in positive territory for the year through Friday's close, and that was despite being down double digits at one point in the year. So that's really, to me, kind of a nice illustration of some of the points that Alyssa was talking about not timing the market, staying invested. again, a lot of volatility, but we're actually positive on the year, riding out some of that volatility and just simply staying invested. On the other side of the investment equation, we have bonds. So investment grade bonds, which is proxied by the U.S. Aggregate Bond Index, which is one of the most widely referenced bond indices in the world. They were up 0.4% in April and up 3.2% for the year to date through April. So, eking out a small positive return, which has been good to see. So unpacking the year just a little bit, I have mentioned volatility has, of course, increased. A big reason was or is because of diverging global policy, and especially around U.S. trade policy. And in fact, there have been some notable themes this year about what's driving markets and what is being talked about and watched by market participants, which I'll tick through. The first is a change in market leadership. We have non-U.S. markets doing particularly well. You see, the Euro area up 18% through April, the United Kingdom up 13% through April, whereas you see the United States down 5%. So it's been a bit of a reversal, as the U.S. stock market has been the best performing market over the last 2 years. So definitely a change. And even zooming in a little bit more, you've seen almost a reversal within the market too. So large technology companies have been driving a lot of the gains in U.S. markets, and these companies, the Microsoft of the world, the Nvidias, the Apples, and things like that, they've actually underperformed year to date. So again, a bit of a rotation and a change in leadership so far. Not even halfway through the year, so we'll see where we end up. But that's been something that's been worth noting. Bond markets, which tends to be the risk-reducing, safer part of investment portfolios, and are not meant to really be very risky, especially when you're investing in investment-grade bonds, have seen a pretty dramatic increase in volatility, especially around Treasury yields, which tends to be referred to as the safest place to invest. Definitely some volatility and jumping around of yields there. The third theme I'd point out is the U.S. dollar. For most of us, we don't really think about currencies. We all live in the U.S., or I'm assuming we all live in the U.S., spend in dollars and have incomes in dollars, but the U.S. dollar has weakened pretty dramatically versus other currencies, and that's been another change in markets as the U.S. dollar has been appreciating pretty significantly. So not to be the bearer of bad news, but if any of you have any fun summer international travel plans, the dollar won't go quite as far as it has in years past. So that's another thing to point out. The fourth thing is hard economic data. And when I say hard economic data, think things like unemployment, like economic growth. That's actually been holding up quite well. The economy, despite all the things that are happening, despite all the headlines so far, is holding up pretty well. Of course, we don't know exactly, what will happen given some of the policy changes, but where we stand today, we're not in a recession, and hard economic data is holding up pretty well. However, speaking of a recession, there does appear to be an increased odds of a trade policy induced recession, given some of the things that are happening, that might impact demand and things like that. However, given some of the announcements over the last few weeks that have been seen as a positive on that front, I actually saw one prominent economist cut his recession odds from a little under 50%. He basically a few weeks ago said, the odds of a recession over the next year was around 50%, and that's been cut to more like 25% based on some of the news that's been trickling. So, I mentioned this already, but again, I think given what's been happening this year and the fact that markets are, actually doing okay where we stand today, is one of the many, many reasons that we take that long-term approach. We stay diversified. We don't look to time markets and move around risk, and again, really take the long view and stay invested and allow the Montana portfolio to benefit on the long-term trend of equity markets, which is higher. So of course, there's plenty more to talk about with markets and the news, but perhaps I'll stop, give it back to Alyssa, and if there are market-related questions, I invite folks to jump in at the end and ask away. So, Alyssa, why don't you take the mic back, please?
Okay.
Thanks.
Thanks, Tim. So next we have our portfolio highlights, which is just a dashboard providing a snapshot of some of the key stats that we look at. On the left-hand side of the page, we can start there. You'll see a colorful donut, and this is reflects our current positioning as of the end of March. In the donut, you'll see at the end of the March, the foundation's assets stood at 167.6 million. To provide some of the real-time numbers, I know the markets have been moving quite a bit since then. We estimated that the foundation portfolio was up about 0.6 in April, and through May month to date, we believe the foundation's up roughly another 3%, which puts the current market value around an estimated 173 today. So if we now look below the colorful donut, we have a table showing our current exposures versus our policy targets. Looking at the far right column, we have a column for target variance, and you'll see that we're pretty spot on with a lot of our targets, with just some slight variances in public equity and our diversifying strategies. I would categorize these differences as just some noise in the positioning and not reflective of any sort of tactical positioning. As we covered, we really like to try to stay pretty in line with our targets. On the right-hand side, we have a look of our portfolio performance. Starting with the column that says SI, this is since inception, which has been a period of 8 years and 8 months. And the portfolio has compounded at a solid 7.7% annualized. And this is net of manager fees, Cambridge fees. So that's the net return, and that is in line with benchmark. I think while we would always love to see some value added, I think we're overall very pleased with this absolute return. And looking at more of the intermediate period over the 5-year, you'll see the foundation has compounded in the double digits at 11.5, ahead of the benchmark return of 11.3. Looking at the more near term, those 3-year and 1-year numbers, you'll see that the foundation is up in the single digits, though a little bit behind benchmark. And I think to provide some added context here, the slight underperformance that we've experienced in the near term can largely be explained by our allocation to private investments. You might have joined previous webinars where you've heard us speak about this in the past, but the current market environment has been particularly challenging for privates, which just hasn't kept up pace with public markets. I would say this is something that is expected and a trend that we've seen, as private managers tend to not react as sharply when we see large swings in equity markets. So I would say while privates has been a detractor in some of that short-term performance, which you can also see in the table below, I would note that it does remain a key driver for long-term growth, and some of these short periods of underperformance is not uncommon. Otherwise, looking at our top performance drivers in that table, you'll see that on an absolute basis, equities, specifically the US, has done particularly well. And what we call relative to benchmark, which is just comparing the asset class performance versus its benchmark return. Hedge funds have done incredibly well in the near term, especially given the increased volatility and dispersion that we've seen in markets. We've had some great managers, particularly long-short equity names, who have been able to take advantage in this market environment. And then in terms of detractors, as I mentioned, private investments, which just haven't kept up with the tremendous rally that we've seen in markets lately. If we move on to the next slide, we can take a look at portfolio growth since inception. So on this page, the top half illustrates the growth of the foundation's portfolio in terms of dollars since we began our partnership. On the left, this bar represents the starting value of the portfolio, which sat at about 64 million when we began working together in 2016. And on the right, you'll see that the current value stands at 168 million, meaning the portfolio has more than doubled over this period with a total growth of 104 million, which has been incredible. This growth has been driven by two key sources. The first has been net portfolio inflows. So on a net basis, meaning inflows net of any sort of spend, the foundation has been able to add 32.6 million, which has just provided just such a tremendous foundation for the growth in this portfolio. And the second piece to it has been investment performance, with our investment strategy generating 71 million in value over this past 8 years and 8 months. Bottom half of the page, we have a look at our annual portfolio returns. You'll see that most years have delivered positive results, with many of those achieving double-digit gains, which has been fantastic to see. I think to recap 2024, you'll see the portfolio returned 11.8%, which, while slightly trailing the benchmark return of 12.8%, still represents a solid year of performance. Year to date, the portfolio has maintained that positive momentum, with most recent numbers putting the portfolio up around 4.3% on the year. And with all those years on the far right, you can see that since inception return of 8% versus the benchmark of 7.7%. And finally, the last slide I had to review for the performance section is our since inception performance for our asset class categories to help provide a more detailed look to what's driving that 8% return. So on this page, we are focusing on our categories where we employ active management. Equities are depicted in the different shades of blue, with the bar on the far left representing our total public equity. To the right, in the different shades of the blue, you'll find the different sub-geographies that we allocate in, each compared to their respective benchmarks shown in gray. So you'll find global equity, US equity, developed ex-US equity, and emerging markets. So starting on the far left, you'll see our total equity performance over the since inception period has compounded at a solid 10%, which closely tracks its benchmark, which is the MSCI All Country World Index. Moving towards the right, you'll see US equities have been a significant growth driver, generating the highest absolute returns across geographies at 12.6%. Would say this outperformance reflects the prolonged strength of the US equity market, particularly in the tech and growth sectors, which have really led global markets for much of the past decade. Outside of the US to the right, you'll see that we've been able to add some value from our active managers in the developed ex-US and emerging market space. And then finally, with that purple bar on the far right, that represents our diversified strategies. And our managers here have been able to add value up 5% versus the benchmark of 4.8%. And these are the strategies that really provide that valuable downside protection and diversification, especially during periods of equity market volatility. I think that covers a high-level overview of performance, but happy to open up for any questions.
Thanks, Alyssa. I'll just maybe say a few final things. And of course, we're happy to answer any and all questions, whether it's about our firm, which I know I was cut off a little bit, so I didn't get to cover everything in the team. So apologies, but we are very happy to partner with the foundation. It's been a great 8+ years. We've been very excited to be part of the foundation's growth and some of the successes. We actually just had one of our colleagues, Omar Sanchez, who's the chief investment officer, was in Helena last week for a meeting. I was last there in August. I'll be there in August. Love our trips out there, and I'm really honored and happy to be a partner with the foundation, and look forward to doing it for another 8+ years. So again, happy to answer any and all questions, and maybe Shirley, we can take down the slides and pull them up if there's a specific question about any of the data or content we shared. And I'm sure we weren't so thorough that there's no questions after the after the presentation. And if easier, yeah, put questions in the chat also. Okay. There's a question about the slides. We can send along to Casey and Kristen that if they want to send it along, that's perfectly fine by us. We can absolutely send things along.
Yes, we can include them with the video recording.
Does anybody have any questions? I guess then instead of sitting in silence, oh, here we go.
I see a question. Why is that 4% for interest? I'm not sure I'm following the question. Is that maybe about spending for the foundation? I don't know if Gail, if you could clarify. I'm not sure I'm totally following the question. Or
I had read at one time that there was a cap at 4%. I thought it was for interest on the funds.
Maybe in spending out of the funds. On the return side, I don't think there's any cap on the return in the investment portfolio since we've been working. Has it returned closer to 8%,
Okay.
which is not, it's sort of like like the rate of return or interest you might gain from a bond or something like that. But I don't know, Casey, or if you have any.
Yeah, no, MCF doesn't have a cap at 4% for interest, so.
Is it okay
And
if I
maybe
jump
it's the
in?
payout.
Oh,
Maybe
yeah,
it's the payout.
our annual payout is 4.5%. Is that possibly what you meant?
I think that's what Gail's asking about, and that
Okay.
is limited to soften the distribution each year so it doesn't swing. You guys average 3 years for us.
Yep. Yeah.
Okay, thank you.
Yeah.
And maybe just importantly, with that payout and then the return of 7.7% for the investment portfolio, I think a main goal that we're trying to solve for is to make sure that return is higher than any spending that's coming out of it, so that we can grow the portfolio, which over this time period has absolutely been achieved. Okay, I see there's a question from Mark for deflationary investments. Yep, we use high quality bonds, which in this case is really treasury bonds and cash to protect against any sort of deflationary or recessionary environment. There potentially could be other asset types, but for us, we think of that as the very safest, most liquid defensive assets It's also a source of spending in, any sort of economic shocks. So we use high quality treasury bonds. We don't like to get cute or take any sort of undue risk in that part of the portfolio. So again, you could think of that as just the highest quality treasury bonds for a deflationary type of investment. But there's also cash as well. So that's part of it. Cash today is yielding a little over 4%. But cash is also a part of that kind of safe deflationary investment. Last call for any questions. Anything on anyone's mind, markets or investment portfolio related, we are more than happy to cover or discuss.
This is Gail again. Basically, I have a small fund with MTCF. Are we able to change the makeup of the funds at all? Just curious. Or is that set by you, the investors, to try and get the people who donate and have these funds in
Yeah,
order to go ahead?
Hi, Gail. MCF's investment committee sets the positioning allocations that were presented today in the presentation. And usually those aren't changed significantly unless there's things that are going on in the markets that need us to rebalance, I guess. Is that the safe way to put it, Tim? And so currently, your endowment would be part of that investment strategy. Is that what you're wondering?
Yeah, I just was wondering if the individual funds have any say or determination in how the funds are invested, out of curiosity.
Typically not on an individual basis. They are not. It's all pulled together, and that allows for some protection of your funds as well.
Okay. Thank you.
Any further questions?
Can I ask one more quick?
Sure.
Tim, I know you've addressed this somewhat. And I just want to hear it again so I can tell my board, because they're watching the market's volatility. They've seen Moody's downgrade our sovereign credit rating down a notch. I know that the long-term view is slow and steady. It'll be fine. It'll work itself out. I got that. But what should I tell my board as they're watching that and sense making? How would you speak to that?
Specifically about the debt downgrade, or just about everything that's been
Yeah, not just
really
about
happening?
everything, but in your strategy, you've talked about using equities as like a long-term strategy against inflation. But how is our U.S. Treasury debt being downgraded going to impact that strategy? I'm not sure if I'm saying that right.
Yeah.
Just how do I address their fears and concerns that we're going to be okay?
Yep, that's a good question. Yeah, I guess a little bit of background. This is the last of the three major credit rating agencies to downgrade U.S. debt. I believe the S&P Standard & Poor's downgraded U.S. debt, and I think it was 2011 or 2012. And then this isn't the first to happen. And while I would say it's, it signals what's happening, I there are not many AAA rated debt issuers. In fact, I actually was looking at this today. If you look at the investment grade universe, and you just look at companies, so you look at companies, and for a long time there were many companies with AAA rated securities. There's actually only two currently, Microsoft and Johnson & Johnson. There are no other companies with AAA credit rating. So despite being AAA down to AA, it's still very investment grade. It signals high quality. It signals that there's some things going on, and potentially that means a higher yield. The U.S. might have to pay a little bit higher to kind of offset that. However, that might impact that part of the portfolio, but it's also why we diversify. It's why we don't have all of the investments in U.S. stocks and treasuries. There are lots of other pieces in the portfolio that are meant to ride out, the volatility that's occurring. So that's what I would focus on by talking to your board, is the diversification is, meant to weather some of the storm. It's not meant to protect against all volatility. It's meant to soften it a little bit and to provide levers of liquidity, levers of spending, levers of protection, the offense and defense. So that's really incredibly important. And it's incredibly important for this portfolio, but it can be incredibly important for a personal portfolio too, especially if you have to spend. The diversification is one of the most important tools that an investor has. So it's why we have U.S. stocks, we have non-U.S. stocks, we have emerging, we have diversifying strategies, we have private equity, we have venture capital, we have cash, tips, treasuries, and other things. So, while reading the news, it's hard to have a particularly rosy view of everything. Newspapers are meant to sell newspapers, so they can take a little bit of that approach. But yeah, diversification is probably what I would say. It's why we don't just have treasuries. So I don't know if that's helpful to answer your question, but that is something we did take note of. Just taking a look at the chat to see if there's anything else. I saw some things come through.
In relation to the comments in the chat, and just to add, our committee loves looking at the quilt. It's just a good reminder and a very visual reminder that something that's top today can be bottom tomorrow. And so that's why diversification is so important. It's one of our favorites.
Maybe there's another, it's somewhat of a similar sort of chart, but it illustrates the same kind of principle. I was looking at the other day, I think it was for the S&P 500, which is one of the most widely quoted, stock market indices, the 500 largest stocks of the U.S. And it was just a chart tracking performance over a long period of time. And of course, the trend is one that's going upward, but there's lots of little seesaws throughout that point. And that this exhibit had pinpointed, had circles and a little text box to all the events that have happened over that time with the markets going up. So the global financial crisis, the dot-com crash, the original U.S. debt getting downgraded in the 2011-2012 timeframe, COVID, things like that, which causes those short-term blips, which at the time can be incredibly scary and for obvious reasons. And there's that volatility that occurs. But, taking that long-term approach, adding some diversification to meet spending and to have other sources of return and defense is, the approach that we think makes the most sense. It's been a successful approach to take. And so that's just another, illustration that kind of is similar to that quilt chart of that principle of a long-term view and leaning on diversification. And we will share the slides so those can go out as well. These are great questions, by the way, very, very important. Maybe last call, round two for for questions. See if there's any last questions or things that we can help with. And it's been nice spending time with all of you and sharing what we're trying to achieve and help the foundation grow. Let's see. Do you prepare future projections like 10 years? Sort of. I know that's not a great answer. We use 25-year asset class projections. And the reason it's 25 years is meant to be a very long period of time. We call it our equilibrium return assumptions. It underpins some of the modeling we do. And that data is meant to say that over a 25-year period, on average, we would expect the asset classes to return, you know, the numbers that we have. While 10 years might seem like a lot, it's incredibly challenging to make return projections. You'll see some of the banks will make short-term projections. They're basically always wrong. You may have read some things about economists who do things like project or estimate, you know, what GDP growth is going to be or where the S&P 500 is going to finish. They have a notoriously poor hit rate, and so we tend not to do it. So we tend not to have, you know, kind of intermediate, which is what I would categorize the 10-year time frame of return projections. Having said that, we do think equities and private investments, you know, will achieve above inflation and above spending returns. So that's high singles to low doubles. We wouldn't expect bonds and you know, less risky assets to do that, but we think it's notoriously difficult to make, you know, precise projections for really any asset class. Great. Well, like I said, really wonderful to spend time with all of you. I hope this was at least somewhat helpful. You know, like I said, we are honored to partner with the foundation, and you know, we'll continue to work hard on behalf of the foundation. And thank you all for your time. And if there are any other questions, maybe you can filter those to us. We'll share the slides, and I believe we'll have another one of these in about 6 months. Hope everyone has a great Monday, or rest of your Monday.
Thank you, everybody.
Bye-bye.